All right, welcome to another episode of Ask an Expert Friday. My name is Stephanie with our Beauty Referral Network, and every Friday we bring somebody on that shares some really great advice with all of our members in our community. And we really want to make sure our businesses that are in our community are set up for success as well, and anybody else that's within our community that is going to be making some money off of our platform. So today I've got Brandon here that's going to discuss some tax planning and some other fun financial stuff that some people tend to avoid. And everybody wants to know how to pay less taxes. So if you don't want to pay less taxes, this is probably not the video for you. So I'm going to let Brandon take it away and introduce himself and share a little bit about what we're going to be talking about today.
Awesome. Thank you so much for having me here today, Steph. It's great to meet you all. Thank you all for making the time. So my name is Brandon Newell. I am a chartered financial analyst, so I have a CFA designation, and I am an executive investment banker. So I was at an investment bank for about 10 years. I've done anywhere from institutional investing to private wealth management, which brings me to my current endeavors. My main bread and butter these days is advanced corporate tax planning for private Canadian corporate business owners. But I do the whole spectrum of wealth management. I do tax efficient investing, insurance planning, basically anything as it pertains to trust, estate planning, investing, and obviously tax savings for business owners. So I do have a presentation. Should I bring it up, Steph?
Yeah,
Awesome.
absolutely. Let's bring it up.
Let's see if I can make this work. Okay. Slides in here. Oops. Computer. Upload file. And presentations. There we go. Now that should come up here.
I don't see it popping up here.
It's saying processing.
Okay, so we'll just give it a minute. Where are comments? Here we go.
Oh, excellent.
All right, Callie is also watching us. She's joining us.
Awesome. I love the enthusiasm. Thank you so much for everyone. It's exciting. Just in case you didn't know, taxes are very high in Canada. Okay, so this is
Here
just
is our
slide
slides.
one. So this is, of course, prepared for you all today. Our whole thing at Global Solutions, by the way, I'm a managing director of Total Portfolio Solutions at Global Solutions, which basically just means that I do all of the things that I mentioned to you. I was an ex-bank treasury expert. And what that means is that basically, if you don't know how banks make money, essentially you go in, you put money in your checking account at 1.9%, you earn interest at that rate. They turn around and lend it out 5% fixed to a 5-year mortgage for other people or whatever that may be. Essentially, they're creating something called a net interest margin for themselves. And what I do best is show people how to actually do that for their own personal lives instead of going to a bank and having them make the money off of them. Our whole thing is revolutionizing wealth and tax advisory across the globe. We do have a global platform, and we're all about breaking silos and embracing collaboration. So I'll just start out by saying that we notice one thing in this industry is they're very fragmented. Usually people will have one financial advisor, maybe an insurance planner, maybe a tax lawyer, maybe a tax accountant. So what we did was we just brought them all in house. We provide comprehensive solutions-based opportunities for our clients that are all comprehensive in nature. So essentially, we all sit around the table. We look at individual files. We all offer our opinions so nothing gets missed. So never again will you go to the end of the year and say, in your accountant, have you say, hey, you have a big tax bill because your investment advisor told you to buy GIC at 4% because it looks great with the current context of interest rate environments. But then you go to the tax man and you realize you only made 2.5%. So who am I? I've kind of already told you. I'm a CFA, chartered financial analyst, ex-executive at an investment bank. I did 7 years at a firm called Women in Capital Markets, where I became the first male appointed chairperson of that board. It was very important work for me. I've done a lot of charitable and philanthropic work in my past as well. Current endeavor is rescuing dogs. So if anybody wants a dog, we're rescuing about 51 over the next week. So that's also something that I like to do in my spare time. Again, the value proposition, we're mainly a family office oriented, but I do help individuals and families. It's very important to me to kind of do that. Of course, we love our high net worth clients, but the reason I left the investment bank was to make a more tangible impact on society in my next chapter of my career. So I would love to talk to anyone and everyone who wants to hear what I have to say about tax efficient investing, tax savings, what to look for before you sign the bottom line or the dotted line to protect yourselves and your family. As you all probably know, when it comes to insurance planning, there is quite a bit of moral hazard in the industry as it pertains to investors and the way that advisors are paid and charged commissions. So the solution at Global Solutions is solving the problem of the fragmentation, where we just bring everyone in the house. Like I mentioned, we all collaborate to provide you comprehensive solutions. We show you what it looks like when things are done poorly. We show you what it looks like when they're done properly, and then we let you decide which one you think makes sense. The difference in Global Solutions, like I mentioned, all of our guys people have, kind of 25 years minimum of experience. I'm kind of the most junior person with about 14 years experience in finance. And what we do is estate planning, risk management, which includes insurance planning, critical illness, disability, essentially showing people how to risk manage their businesses around their lives and their health, with the ancillary opportunity for tax savings and other benefits along the road. But the whole thing comes down to wealth preservation and accumulation over time. We don't do today, tomorrow strategies. Everything that we do is very long-term oriented. We think that that's the best value proposition for our clients. This is just kind of a list of our nerds, the CPAs that we have on staff.
Brandon, we have a quick question.
Oh, great. All right, let's stop and do that.
Is it better to have a trust umbrella corp and a group of companies under it, or LLC? LLC, I believe, is in the US, though.
Okay, awesome. First of all, I'll book whoever wants a Zoom call after this at any time. And so that is a very specific question. That would depend on whether you're US domiciled or Canadian domiciled. That is something that requires a fact-specific search for me to be able to give you a proper opinion. So I would love to talk to you about it, and I will also have my tax accountant on the call as well to advise. He does most of the trust setups and things like that, but there are certain thresholds, certain objectives, and certain timelines associated with trust specifically, which all we need to understand your specific situation.
Perfect.
And again, this is just kind of our multi-family office setup. Again, you do not have to be a family office to be our client. This kind of looks expensive. It is not. Essentially what we did was we had a massive client. It was about a $14 billion family office in China. They really liked what we did on the tax planning side for the Canadian domiciled businesses. So we basically split the capital investment with them, set up a global platform so that we can service you like you're a family office, even if you're an ultra low net worth individual, which I think is pretty great, because part of my endeavor leading the investment bank was I want everyone to have access to good financial advice. And that is something, in my opinion, you shouldn't have to pay for. So our planning process is just basically a comparison of ours versus others. We will do like 8 or 9 meetings with you. We do not come in and, 1 meeting, 2 meetings, and then finish. We do a full fact find. We design solutions. We review everything with your accountants. We'll replace your accountant if you're not happy with them, but we don't look to replace them. We do look to collaborate with them, just because they're the ones that know you better than we do. And of course, we want to get you the best results. So we have internal accountants that apply on our strategies, but we love to partner with the current ones that you already have on your pay to help out as much as possible. And then obviously we qualify strategies, and we don't just implement strategies and then say, hey, go enjoy your life. We check in, every 3 months, 6 months, or a year, depending on how dynamic your situation is changing. And so this brings me to kind of my first area of what I wanted to talk about in terms of investments, because I mentioned moral hazard in the advisory space. And it seems to me like when I got into this space, every single financial advisor wants to sell life insurance to their investors. Now, here's the thing. Life insurance is a great product. Life insurance is something that, in my opinion, is necessary for just about everyone, unless you have zero liabilities, zero obligations, and zero dependents, and zero people that you want to leave the fruits of your labor to when you're gone. However, there is a right and a wrong way to use insurance. So basically, what I did is I just put together a couple of slides here on how to prioritize your investments. If you have an advisor approaching you, telling you that you should buy insurance, the first thing that they should actually be asking you is, do you have a TFSA set up? I'm assuming that everyone here knows what a TFSA is, but between that and the FHSA, which are on this slide here, are basically the only 2 remaining completely tax-free accounts in Canada. There used to be all this other stuff that Justin Trudeau and his friends have done a great job of abolishing over the past 8 years. The reason taxes are high is because they want you to pay them and they don't want you to avoid them. And we don't do tax avoidance. What we do is we show you strategies that reduce your taxes during your life and upon your death. So there's quite a big difference, and I'd be happy to discuss that with anybody who wants to get into the nitty-gritty details about how I have to market that to remain compliant, because these are important issues, and it's something we take very seriously at Global Solutions. Basically, the TFSA, very flexible account. The money that you put into it is not tax deductible, but your investment income, dividends, everything else is all tax-free. You can grow it as long as you want until your death. You can pass it along, all these great things. If you take money out of it and you put it back in it, you maintain the room, you don't lose it. And obviously, they have actually increased the limits from $5,000 or $6,000 when it started to $6,500 in 2023 and $7,000 for last year. Don't worry if you didn't fill this up. You can definitely do that going forward, and you can carry it forward as long as you want. The problem is that if you put too much money in, you'll be taxed on it, but you should have a financial advisor to guide you on your limits and be able to monitor that. You can also see it on the CRA website. But the TFSA is the end-all, be-all. You should not do anything else. If you don't have a TFSA, you should not be investing anywhere else, period. And if anybody ever tells you anything other than that, they're probably trying to rip you off. Sorry, I'm very blunt, but I'm seeing I like this guy, so I'll take that compliment. And thank you very much. First home savings account is basically geared for first-time home buyers. Don't worry if you put money in there. It's not a big penalty. You just won't pay tax on any of the growth or anything. Very similar to a registered education savings program. I am actually not an aspiring home buyer in Canada because I have a real estate fund in the U.S. and the accounting rules in the U.S. are very, very much more favorable relative to Canada. There are things like accelerated depreciation that allow you to create large expenses that you can use to offset against rental income, etc. If anyone's interested in real estate investing or wants to have a conversation about why it makes sense for me living downtown Vancouver to rent property, i.e. a condo, and then invest somewhere else so that I'm not inherently short the real estate market. And what I mean by that is that you always got to have a place to live unless you're comfortable living on the streets, which I am not above it, but it's nicer to have a home. So if you assume that you have to have a place to live and you don't own it, and you don't invest in real estate elsewhere, you're inherently short it because your rents are eventually going to go up, or maybe they go up every year or whatever. And also, if you're going to buy a home, it's going to go up. So you want to have some sort of exposure to real estate, in my opinion. But for me, it's not owning physical property, at least not in an urban city that's overpriced, in my opinion, like Vancouver. So I prefer to do it in the U.S., where the accounting rules are more favorable. The returns are more like 20% net of tax, no tax per year. And if you look anywhere in Canada, I would be very hard-pressed to get that in a stable real estate investment without taking on excessive downside risk. So basically, this program is geared towards that. It's a great program. You put in $8,000 per year. I believe we've done it for 4 years now. This will be the 5th. So it's $40,000 lifetime limited investment amount plus 2025 contribution room. And it is a very flexible program. However, it's flexible in the context that it's the only other way to never pay tax on your investment. However, the only way to actually achieve that, unlike TFSA, is to use it for a property purchase. The great thing about it is that if you haven't owned a home in the past 4 years, but you did prior to that, you're actually able to use this program more than one time. So a lot of people don't know that, but it's a key feature because you can buy one property, sell it, in a few years, and then if you're without the program for 4 or 5 more years, you can actually start using it again.
That's good to know. I didn't know that.
Yeah, thank you very much. Were there any other questions before I continue?
It doesn't look like it right now.
Awesome. I guess they'll just come in, so I probably don't have to ask, but I'm known for kind of powering through without stopping, so I'll just keep an eye on the board here.
I'm sure there's going to be questions after when people watch the replay too, so.
Okay, that'd be awesome. Yeah, please send them all my way. Happy to help out as much as possible. And so the next, as we continue down that hierarchy of what you should be doing in order to live a tax-efficient life and optimize what I refer to as your retirement nest egg, RRSP. Now, I don't have an RRSP. I prefer to use whole life insurance. We can always talk about the idiosyncrasies associated with the RRSP, but here's the thing. You put in money, of course, is a taxable benefit. So you put in 18% of your earnings each year or whatever you can muster up. You get the tax credit. That's all great. And of course, none of the growth is taxed or any capital gains, dividends, or income are taxed, until retirement, at which point they are taxed, though. And it's obviously on the largest part of your nest egg at that point. So to my mind, it's not the number one thing that I do, but Yes, I do have time today. I have another call after this, but I'll be available around 3. So if you'd like to send me a message, I'd love to connect. And so, yeah, so basically what I'm getting at is the RSP is not for me. However, it is right for someone. For example, if you're not a business owner and you're a T4 regular income employee, you should be using RSPs. There is an argument to be made that whole life insurance can be compared, like something compared, and we'll go through that product detail here in a couple of moments. But just you can kind of assume that if you're a T4 regular income earning employee, that there's going to be a lot of benefit to you using RSP. I would advise differently for a business owner because there's something called corporate whole life insurance, which is a great product that allows you to shelter those retained earnings so that you can eventually pay them to yourself without having to pay salary and or dividend tax as a business owner, which can be taxed at very high rates. The last one is registered education retirement savings plan, registered education savings plan. I like this. I mean, I really like this, but the problem is, who's sending their kids to school for 50 grand these days? I didn't even, it was more expensive than that when I went to school, 18 or 19 years ago. So it's a great program. If you have kids and you want them to go to school, it's one that you should use. However, there are other products like whole life insurance and universal life insurance that we'll get into in a moment where you can build in more flexibility, because with this registered education savings plan, you do have to use the growth, the government matching, etc., to fund education, or else you have to pay it back when you close it down. Say that your kids turn 18 and they don't want to go to university. They're the next Elon Musk, for goodness sakes, but they don't have 50 grand to invest in a business. And if you take the money out of this to invest in the business idea they have, then you're paying massive tax on it. Well, I like other products because they provide more flexibility. And if your kid wants to start a family and have a home at 18, they can use it for that. If they want to start a business, they can use it for that. Or if you're going to force them to go to school even when they don't want to, they can still use it for that. However, the RSESP, while it's a great program with the government matching and the tax-free growth, it is punitive in the nature that it lacks flexibility. Oh, and then the other accounts, so just for people with special, I don't want to say special needs, but, who are with disabilities or things like that, there are other things. One is called an RDSP, Registered Disability Savings Plan. There are also things like pooled registered pension plans and registered pension plans, which you can get from other financial providers. We offer them as well. I can go through in detail why I don't think that they're efficient or effective over something called whole life or universal life insurance policies, if anybody would like more color on that. And so lastly, it brings me to the insurance, which, everybody wants to sell because it pays extremely high commission. And the problem with that is that there's a right way and a wrong way to do this. For example, if you do not have a TFSA and you have someone saying, here, you can use a whole life insurance policy because it has tax sheltered growth just like a TFSA. They couldn't be more wrong. And the reason they want to do that is because they don't make any money selling you a TFSA. For me to set up TFSAs, which is what I will do first before I will do anything else for every single one of my clients, no exceptions, is I will set them up a TFSA and I will earn nothing. And that is fine because it's the right thing to do. And unlike when they find out that someone sold them a whole life insurance policy they don't need, they're my client forever. Also, so are the ones where I come across who have these whole life insurance policies who don't have TFSA set up. There are extenuating circumstances where whole life insurance can make sense when there's not a TFSA set up, but it wouldn't be without the intention to at some point fulfill the TFSA. The first product I'm referring to is whole life insurance, which I've mentioned a couple of times now. The purpose is it provides lifelong coverage. So what you do is you'll pay a stable premium. So none of this like renewable term like you have with term life insurance where the premiums increase as you get older. The insurance takes a risk on your life at the time it's initiated, and your premiums are stable for your life. In fact, at some points, if they're structured properly or by design, if that's what meets the client's needs, you can actually structure them so that after a period of time, you don't have to pay for them anymore, and you still maintain your lifelong coverage to be able to pass on your legacy to your kids or whoever else you care about. They have two components, a guaranteed death benefit and a cash value component. Now, the cash value is the investment. So I'm going to tell you a little story about a client I met a little while ago. Okay? They went in to see a financial advisor who solicited them on LinkedIn or whatever. They wanted $1 million in life insurance, and they really only needed term life insurance because they didn't have a TFSA set up. And the right way to do this is to invest in the TFSA, the tax-free savings account, get the complete tax-free treatment, buy term life insurance, which is very, very cheap. And of course, it will get more expensive when you renew it when you're older. But another thing that people don't know about term life insurance is that it has a convertibility feature. So when you're young, if you lock in that cheap premium for 20 years, you pay the premium every year, and of course you don't get anything in return, but that's not quite true. What you do is you actually lock in something called a convertibility factor. Because like I said, the insurance company is taking a risk on your life at the time that they initiate the contract. They don't care if it's permanent insurance, which is whole life, or temporary insurance, like term life insurance. They don't care. So what they do is they embed an option to actually convert it to permanent life insurance if it makes sense. So what the whole life insurance does is, back to my story, this person went in to see their advisor. They wanted $1 million in life insurance, and they chose whole life because the advisor sold them on it because of the cash value and the investment component. Here's the thing, though. As an investment advisor, when we sell an insurance product, we don't really get paid too much for the investment amount. However, amping up the investment amount, and you can tweak these figures. You can literally tweak them and it'll adjust the premiums, and I can go through that on an individual basis for anybody who's interested to learn more. But essentially, you can literally crush the investment value down and make it basically very expensive term insurance by boosting up the death benefit. So what this person did was they wanted to apply for $1 million. They liked the way that something called the policy illustration looked when they looked at the way that the investment grows over time. The investment advisor responds, okay, that makes sense. Probably $1 million makes sense for you. However, I think we should apply for $2 million. It's always better to apply for more. That way we have it in the future if you want to use it, and you can always choose to just take $1 million if we get approved for more. What happened was, a month later, they got the approval back. The advisor's presenting it to the client, and they say, look, you can now get $2 million of whole life insurance instead of $1 million, and your premiums are the same. Well, the client said, that sounds great. I'll do that. Remember what I said about me wanting to provide transparency to people about knowing where to check before they sign the dotted line to protect them and their families? Because here's what happens. What do you think that the cash value component of the $1 million policy look like versus the $2 million policy? Well, I can tell you, it's about half as much, and you're paying about twice as much for the death benefit. So then 2 years later, when they decided to take a look at what I refer to as their in-force policy illustration, they had a look at it, and they had almost zero cash value growth. They had a great death benefit of $2 million, which they didn't need because they didn't have any dependents. They were doing it for investment purposes, but they didn't get the product that they need. And unfortunately, the advisor made about twice what they should have gotten paid on the commission because the insurance component was elevated, the investment component was decreased. So this is why I really like to go through the nitty gritty in these things and show you exactly what it looks like and how punitive. And I do have a demonstration here, which I'll get to. I know we're running short on time, but I'll show you just what it looks like in this type of scenario. And the great thing about it is flexibility, because what I was getting at, like with the kid thing, the RESP, the Registered Education Savings Plan, is very non-flexible. This, you can use it for your whole life. And the great thing is that if it's done properly, and I stress if it's done properly, you can actually borrow against it and use those funds to invest. And remember what I said about banks? The reason banks are able to do what they do is because they create their own something called HQLA. It is a regulatory requirement and a bank kind of gold standard. It is called high quality liquid assets. And what they do is they use these assets to be able to generate liquidity. So what you can do with this is, it's the same as if you own $1 million home and you go to the bank and they give you $800,000 against it to invest. You still get full exposure if the house goes up. Same with insurance. The whole life insurance pays a dividend every year, and you get to receive that dividend no matter whether or not you've posted it as collateral and taken a loan against it. So what it allows you to do, and some advisors refer to this as infinite banking, which I do not, because there's nothing infinite about it. However, it is as simple as this. Your money works in two places at once because it works tax-free inside the whole life insurance policy. You borrow against it, so you pay one interest rate on the loan. And then obviously, if you're borrowing against it, you're using that loan for something. Usually my clients use it for investing, which means that you're making money on the investment and the whole life insurance policy while you're only paying interest in one place, which is the loan. And effectively, you can see now how you're making it like a bank, because what you're doing is you're creating a net interest margin for yourself by borrowing against your own facility that's still making tax-free dollars for you in your future, while reinvesting it on a taxable basis on another product. Universal Life works very, very similarly. However, unlike whole life insurance, which pays a dividend every single year, Universal Life, it does not have a guaranteed dividend. It can have some guaranteed accounts. You can choose that if you want to. However, what the great thing about Universal Life is, and why I love this for kids, is because you actually are allowed to pick like the equity indice. So for me, it's like my clients have for clients that are making like 500 grand a year where they've used up the RESP, they've put a bunch of money in their own whole life product, and they're a little bit older, so the insurance is a little bit more expensive. We go and stuff this full of their kids with universal life so that they can gift the money to their kids now, not be taxed on it because there's no gift tax in Canada, put it into universal life, and then they have equity exposure on a tax-free basis, until they want to use it for something like buying a home, starting a business, or going to school. So we can talk more about that. I know I'm kind of moving a bit quick. How am I doing on time, by the way, Steph?
We should probably wrap it up here pretty soon.
Okay,
if anyone has any questions, though, they can always drop it in the comments, and you can either come back and respond later. We'll have your contact info in there as well. So if anyone has more specific questions or wants to book a call with you, then they can get in touch, because this is all really good information. We might have to do like a whole second Zoom session just to talk about this universal life.
If it means people get the right financial advice, I'll come on here every day of the week and 3 times on Sunday until it's hammered home. But I'm glad that it's recorded so people can look at it and we go back, because I did go a little bit fast. Here is the thing. It's a lot of information for half an hour, but I would love to spend as much time as required with anyone on this call or anyone else just to educate them. And if it goes nowhere, that's fine too. I'm just here to help. And I find that if the value is put first, then we both make money going forward. It's very simple to me like that. So
Exactly. But this has been such great information for our community, because everybody needs to know about this universal life insurance. So many people have no idea, or I've sent you something actually in the past. I'm like, this ad that I still keep popping up that says you can get it for as little as like $3 something a day or whatever it was. Something just crazy. So
yeah, unfortunately, that's what
you're signing up for.
And I think I remember I said it's a bit bogus, that one. So here's the problem. It's like insurance. There's tons of insurance marketing out there. What they do is they try to get people hooked from the marketing ad, and then they try to kind of finagle some solution that makes them a bunch of commission that doesn't really do what they say. So I literally go through exactly what that looks like, exactly how I do it, so you can see the difference in value.
Yeah, amazing. Okay, awesome. So I'll put your contact info into the descriptions of this video so that everybody has that and they can get in touch with you anytime.
Awesome.
But thank you so much for coming on and sharing all of this amazing information. As I said before, everybody needs to know tax planning and universal life insurance and all the money things, because so many people have that component in their life.
We have really only scratched the surface. So if there are a lot of business owners specifically, I can literally have a call and go through all of the ways that we work with business owners. Just because here's the thing, the T4 regular income earning employee in Canada is kind of at the peril of the government. There are very few things we can do. There are still things we can do, but really the bread and butter is for the business and the Canadian private corporate business owner that we can really help. So if anybody wants me to come back on or has any questions, I would be more than happy to do it. Also, what's the best way for me to get in touch with the people who have asked for calls?
Well, this one's Callie that asked for a call, so I can just send you her info. And awesome. Anybody else?
Callie, I'll see you this afternoon.
Yeah. For everybody else, we'll probably just put your email on there and they can get in touch with you and just mention our Beauty Referral Network. But perhaps we should have you on a special call for our VIP members only, because they're all of our VIP business members, and do some money discussions with them.
Awesome. I would love to do that. Yeah, it's like I love to talk about like US real estate, go through the account. Like we can get right into the nitty-gritty of the accounting idiosyncracies. That's the kind of stuff
I think that would be really great to bring to our VIP community. So
awesome.
Thank you so much, Brandon.
Thank you again,
have a fantastic day, and we'll see you guys on another episode of Ask an Expert Friday.
Thank you so much. Have a great day, everyone.